Imagine waking up one morning and discovering that your retirement account just bought stock in a company losing billions of dollars a year. Not because you chose to buy it, not because your financial advisor recommended it, but because the system automatically bought it for you. Now imagine that company is valued at nearly $2 trillion, more valuable than entire industries, more valuable than some countries, and potentially the largest IPO in human history. That company is SpaceX. And according to a growing number of analysts, the public isn't being told the full story because SpaceX isn't just a rocket company anymore. It's actually three separate businesses fused together: a satellite internet empire printing cash, a rocket division burning capital to dominate space, and an AI company that may be one of the most aggressively priced assets Silicon Valley has ever seen. But the most important part of this story isn't even the company itself. It's the rules. Because while most people were distracted by headlines about Mars, AI, and Elon Musk, NASDAQ quietly changed the rules in a way that could funnel billions of dollars from passive investors directly into the IPO. And if you own index funds, you may become a buyer whether you want to or not. When most people hear the word SpaceX, they picture rockets, explosions, launch pads, astronauts, mascolini. But rockets are not the real business. In fact, the rocket division may be the least important part of the entire company financially. SpaceX today is really three companies stacked together under one giant valuation. And understanding those three layers is the key to understanding why this IPO matters so much. The first layer is AI. More specifically, Elon Musk's AI company, xAI. Most people know xAI because of Grok and its connection to X. But here's where things get weird. SpaceX reportedly absorbed xAI in an all-stock arrangement valuing the AI business at hundreds of billions of dollars. And that valuation raises massive questions. Because unlike competitors such as OpenAI or Anthropic, xAI's revenue is tiny by comparison. Yet the valuation implies it belongs in the same league. And that's difficult to justify financially, especially considering reports that the company has been burning enormous amounts of cash while struggling with organizational instability and leadership turnover. This is where the story starts becoming less about innovation and more about narrative, because valuation in modern markets is no longer just about profits. It's about belief. And Elon Musk may be the greatest narrative engineer in financial history. He doesn't just sell products. He sells futures. Electric cars weren't just electric cars. They were the future of transportation. Rockets weren't just rockets. They were the future of humanity. And AI isn't just software. It's the future of intelligence itself. The question investors have to ask is simple. How much of SpaceX's valuation is built on actual cash flow? And how much is built on belief? Now let's move to the part everyone recognizes. The rockets. This division handles satellite launches, government contracts, cargo missions, and NASA operations. And to be clear, this is still an incredible business. SpaceX transformed the aerospace industry. Reusable rockets changed launch economics forever. Governments around the world depend on them. Even competitors admit the company is years ahead technologically. But here's the problem. Rocket launches are capital intensive. Margins are difficult. Growth is expensive. And even though the rocket division generates billions in revenue, it still doesn't justify a multi-trillion-dollar valuation by itself. Because investors aren't pricing SpaceX like an aerospace contractor. They're pricing it like the next internet monopoly. Which brings us to the real engine underneath the company. The crown jewel. This is the business Wall Street actually cares about. Starlink, a satellite internet network spanning the entire planet. Thousands of satellites orbiting Earth. Internet beamed from space. Coverage in remote regions traditional telecom companies can't reach. And unlike the rocket business, Starlink scales. Fast, very fast. It's already become one of the fastest growing telecommunications platforms in history. And the economics are terrifyingly good, because once the satellites are deployed, every new subscriber becomes massively profitable. This is what changes the entire SpaceX story. The company stops looking like a space company and starts looking like a global infrastructure monopoly, not just competing with telecom companies, competing with internet providers, military contractors, airline connectivity systems, maritime communications, rural broadband, potentially even governments themselves. This is why some investors are willing to tolerate insane valuations. Because if Starlink succeeds at maximum scale, it becomes one of the most powerful communication networks on Earth. And that possibility is worth enormous amounts of money. But even then, there's still a major problem. Even if Starlink is revolutionary, the numbers still stretch credibility, because the combined company reportedly lost billions of dollars while generating under $20 billion in annual revenue. Now compare that to the proposed valuation, nearly $2 trillion. To put that into perspective, that would make SpaceX more valuable than many of the largest corporations in modern history. And this is where critics start asking uncomfortable questions. Is the valuation based on current fundamentals? Or is it based on future expectations stacked on top of future expectations, stacked on top of future expectations? In other words, are investors buying a business or buying a dream? Because there's a dangerous pattern that appears late in every major financial cycle. Narratives become more important than cash flow. Hope becomes more important than valuation discipline. And eventually markets begin pricing companies not for what they are, but for what people imagine they could someday become. Now we arrive at the part almost nobody is talking about: the index rules. Because historically, newly public companies had to wait before entering major indexes. There were liquidity requirements, float requirements, seasoning periods. The logic was simple. Markets needed time for price discovery. But recent rule adjustments changed that process dramatically. And critics argue those changes benefit companies exactly like SpaceX, especially companies with small public floats and massive private valuations. Here's why this matters. Once a company enters a major index, passive funds are forced buyers, not optional buyers. Forced buyers. If your retirement account owns index ETFs, those ETFs automatically buy whatever enters the index. No human decision required. And passive investing has become so massive that this automatic demand can move enormous amounts of capital. That means the structure itself creates buyers, not because investors studied the fundamentals, not because they analyzed the valuation, but because the rules say the funds must buy. And critics believe that mechanism could create artificial demand during the SpaceX IPO process. This is the part that makes people uncomfortable, because most investors believe passive investing is neutral, safe, diversified, automatic, and for the most part, it has been extraordinarily effective. But passive investing has a hidden side effect. It removes discretion. Funds buy based on inclusion rules, not necessarily based on valuation. And when trillions of dollars operate through automatic allocation systems, index inclusion itself becomes incredibly valuable, which means companies don't just compete for investors anymore. They compete for index access. And if the rules governing that access change, the consequences ripple across the entire financial system. That's why some analysts are calling the SpaceX IPO a turning point. Not because SpaceX is a bad company, not because Starlink isn't impressive, but because the financial plumbing underneath the market may now matter more than the business itself. And SpaceX may only be the beginning, because if this IPO structure works, other giant private technology companies could follow the exact same path. Low float, massive valuation, rapid index inclusion, automatic passive demand. Which raises a bigger question. Has Wall Street discovered a new mechanism for distributing ultra-high valuations directly into retirement accounts? Because once passive capital becomes mandatory demand, the normal market discipline weakens. And when market discipline weakens, valuations can disconnect from reality for much longer than people expect, until eventually they don't. Now, to be clear, SpaceX may still become one of the most important companies in human history. Starlink may dominate global internet infrastructure. The rocket division may reshape space transportation forever. And AI could become enormously profitable someday. But none of that automatically answers the valuation question. And it definitely doesn't answer the bigger question. Should passive investors be automatically absorbing exposure to companies at historically extreme valuations? Because whether you love Elon Musk, hate Elon Musk, or simply don't care, this story is bigger than one company. It's about how modern financial markets work, how passive investing changed Wall Street forever, and how the rules governing trillions of dollars can quietly reshape who wins and who becomes exit liquidity. So the next time someone tells you passive investing is completely automatic and neutral, remember something important. Automatic systems don't think. They just buy. And right now, they may be preparing to buy the biggest IPO in history.